But I do think, again, the important point now is that that cycle appears to be reaching a tipping point where Chevron, Exxon, and energy companies and other commodity producers like industrial metals, they're now printing money. Commodity prices are actually high. They're not spending a ton, like their profits are through the roof. And they are now sitting on just like this war chest of billions and tens of billions of dollars. And so I think it will be interesting how they decide to spend their money. And I do think they probably think they know how to spend it better than BlackRock and other investors. And they probably do, right? Like if you're a company executive who this is your job, you spent decades doing this, they know these clean energy industries, they know how to be profitable. And at the end of the day, again, that's all they're trying to do is make the most money for themselves and their shareholders. So I don't know about some of the specific like moral and political and other arguments. Frankly, I think they've pushed back on.
Welcome to AFO Wealth Management Forward, a podcast about finance, accounting, technology, and entrepreneurship. We apply our decades worth of experience and insight into what makes businesses work, so we can help others grow both personally and professionally. In this ever-evolving marketplace, we help accounting firms and financial advisors grow their practice through the adoption of holistic wealth management services. Learn from industry leaders and subject matter experts to unlock the secrets of their success. A podcast that shows people and companies the transformative power of technology so they don't fear it, but instead harness it. Don't fight the robots, team up with them. And here are your hosts, Rory Henry, Director of Business Development, and CEO Rob Santos of Arrowroot Family Office.
Hello, everyone. Today, I'm again joined by Managing Director and Partner here at Arrowroot Family Office, Diane Young. Diane, how are we doing?
I'm doing great. Thank you. It's a lovely day here in the state of Michigan.
I love it. Well, we have an exciting topic here to discuss today. We are joined by a returning guest. He was back on with us during the SPAC craze of 2021. He's a Duke graduate, so we are rival basketball fans since I'm a UCLA Bruin. He is the current climate finance reporter for the Wall Street Journal, where he covers how investors are financing the transition to clean energy. So we're here to talk about ESG. So without further ado, let me introduce our guest, Amrith Ramkumar. Amrith, welcome to the show.
Thanks so much for having me on again.
Awesome. Well, let's dive right in here. There's a big trend in the world of investing, and that's ESG. It's been one of the fastest growing sectors, but it's also receiving a lot of criticism and backlash. First and foremost, can you just kind of talk to our audience about what ESG is, and then some of the issues regarding some of the standard regulations and enforcements that are causing some of the problems here?
Sure, I'll do my best. ESG is a pretty fraught and loosely defined topic, so I kind of lead with that because it's really hard to define and talk about, but I will do my best. So ESG stands for Environmental, Social, and Governance Criteria. The idea being that this is impact investing. So basically, investors will create scores for companies and prioritize those in certain funds that do better. So typically, big tech companies like Microsoft, Apple, they tend to have good ESG scores just by the nature of their business and the fact that they're the most successful companies in the world. So those funds might favor those players. And then across industries, they basically go rank companies based on those criteria, give them scores, and invest that way. And so there are labeled ESG funds, and that's, as you were saying, a huge growing area, a few $1 trillion in labeled ESG funds globally. That's been rising a lot, took off in 2020. People expect that to continue to grow. The much broader point with ESG, and that's causing a lot of controversy, is that big investors like the BlackRocks of the world that manage money on behalf of others, they incorporate ESG factors and a company's impact on society when talking to big company management teams. So there's labeled ESG, and then there's a lot of stuff that happens behind closed doors. And it's really hard, to the first point, to define ESG and say, one company's good ESG score or one investor's good ESG company might be another investor's bad ESG company. So the first part is very fraught. The second part that BlackRock and others say, hey, company X, you should probably do better on this stuff so you make more money over time. Some conservative politicians and certain investors have flagged that and said, we don't want you to do that, just prioritize profits. So we've seen a lot of backlash. We've seen states kick BlackRock and others out and say, you can't manage our small retirement funds. And we've seen a lot of politics really come into play here in the past few months. So it's a really interesting discussion and debate. What I prefer talking about, frankly, is energy and climate investing. You mentioned my job. So people conflate the two. They say ESG is all of energy and climate investing. That's not true at all. Like, my point is, let's stop debating whether ESG is good or bad, and let's talk about the trillions of dollars that need to shift toward cleaner energy sources. And let's talk about the trillions of dollars in potential stranded assets, because that's money, that's deals, that's tangible. And debates about whether ESG is good or bad are much harder to pin down.
Yeah, I got two questions to follow up on. First is, I'd like some stats here. I think I saw you say that, this sector is $3 trillion. And I also read that they're expecting by, I think, 2025, over half of all the assets managed are going to ESG funds. Is that accurate?
The first one is like ESG AUM is in labeled funds, again, about 3 trillion and expected to grow rapidly. The stats vary in terms of what chunk of money will be going in. I've seen some that are, say, like 1 in 3, 1 in 4 of every dollar basically that's invested by companies and investors will have an ESG bend. And I mean, again, this is like labeled ESG.
Yeah.
What's much
Not
broader.
always ESG funds.
Exactly, right? Like, the point is that if you talk to every large investor, which this is all I spend my time doing, they are all under immense pressure to do better in these areas. Every large company under immense pressure. The total number of divestment commitments from fossil fuels among pension funds, endowments, like faith-based religious organizations has just hit $40 trillion. It's a tidal wave of capital that has said, we are going to eventually move away from fossil fuels. So yeah, you can debate like a lot of the nitty-gritty stuff, but it's pretty clear. I like to say the train has left the station, right? Like, people are long-term investing in cleaner energy sources. They are caring about diversity and some of these other issues. You can argue about the best ways to do that and who should be doing that and some of those nuances, but big picture, like, the momentum is likely to continue, because again, this is about making money and managing risk, which fundamentally is what everyone is trying to do.
Yeah, I find it, I do a lot of, or try to help a lot of our clients with social responsible investing. And I always try to have them define what that means to them, because it's different for each person, each pension fund, each, some people, alcohol and tobacco is bad, and other people are like, that's just sin, that's their business. But the energy is an interesting one. I'd love to delve in a little bit more with you, because a lot of my clients in the past have wanted to do an investment or what have you, and or something for a tax break. And I'll be like, well, you can buy this oil and gas break here because there's huge tax breaks for it. Versus there was nothing on the social, they couldn't buy a wind farm and get the equal, tax write-off. So what are you seeing out there?
Yeah, that's a really interesting discussion. I think, to your point about defining this stuff, it's so important. And we often, I think people forget, even just in having conversations like this, or just in trying to make investment decisions, whatever the case might be, to your point, it's so important. And so even just getting in the same ballpark, like, are you wanting to divest completely from fossil fuels, or are you okay investing in big oil and gas companies with the assumption that they will eventually clean up their act, and that them cleaning up their act will be a fundamental part of lowering total societal emissions, which is the prevailing view on Wall Street. Even agreeing on that, I think, is like basic stuff that not a lot of people think about, even in just managing their individual investments. And I'm seeing, just again, a tidal wave of capital. It's remarkable to me how well private markets have held up for clean energy investing and the debt markets. So if you look at financing for this stuff, clean energy, clean tech has still raked in like $30 billion or so this year, just in equity, according to PitchBook. And that's a bit below last year's record clip, but that's much greater than the clips from like 2019 and 2020. If you look at green bonds and sustainability linked bonds, like, companies are still linking their borrowing costs to how well they do on this stuff. And you can say, a lot of people say, including me and others, like, well, that's probably stuff you were doing anyway, right? Like, you're not really moving the needle that much to necessarily, and it's hard to verify. and all of that. With all those caveats, this is where money is moving. This is where the private sector is moving. And I think the big energy companies have started to realize that too, and they've taken steps to invest in things like carbon capture and hydrogen and the new areas where they have expertise and they want to dominate. So things like the Inflation Reduction Act, where it basically says, if you produce lower carbon fossil fuels and you produce cleaner energy, you can make a ton of money and we will help you do that. That's literally the dream of so many Wall Street investors and so many giant energy companies that are diversified and that are going to be able to do that. So
do you think like these states and things like that that are kind of doing this backlash against the ESG movement, the kind of anti-woke movement, I guess I'd call it, do you think because there's money to be made out there that they'll eventually change after the midterms are over, will they change their tune?
That's really hard to say. And I think, again, it's so important to even like define carefully what we're talking about. For a lot of the anti-ESG movement, they don't really even care about fossil fuels versus clean energy, at least explicitly. The undertones might be there when they're talking about that and saying like your divestment from fossil fuels. But the argument they're making is a bit broader and has to do with the fact that BlackRock and others and money managers should only care about profits and nothing else. So that could be energy, that could be factors like diversity or other social issues. But their whole point is Wall Street and others should just stick to their lane and nothing else. And Wall Street's argument is that the best way to make money is to prioritize social issues. So it's kind of like that Spider-Man meme where they're both putting it together and saying, you're anti-free market. No, you're anti-free market. And so I think they think that's the best way to manage their money now and make their point and appeal to their constituents. But even some of those non-ESG funds that hold energy assets are invested in clean energy. That's the whole point. People say ESG is divestment from fossil fuels when it's not. The anti-ESG crowd is not necessarily fully divesting. And
it's the other way too, because I'll have a lot of people think that they've got an ESG fund when it's really something that I met a fund manager the other day at a dinner, and he's like, oh, and I was like, well, I'm very interested to hear your ESG story. And then I looked at the top 20 holdings and I was like, this looks just like an S&P 500 fund.
Exactly. That's the thing that a lot of people...
we hold it for a different reason. And I was like, all right.
Right. And I think, look, the private sector for how many decades, their whole marketing and entire strategy is dressing up stuff in new labels and
putting lipstick on a pig.
Didn't Morningstar or someone do a study where they were like, when the fund just changed its name, how much money poured into it, and they didn't do anything different?
Exactly. And that's like a lot of ESG funds, if you dig a little deeper, the studies and academic studies and others have looked at it and shown like that's basically what it is. It's largely holding big tech and other giant corporations, because guess what? Our economy is driven by giant corporations. Whether or not we fight climate change will be driven by giant corporations. So you can slice it a lot of different ways. You can change the scores, you can slightly modify weightings here or there, but at the end of the day, the stock market is what it is. And like ESG funds might do a little better, they might do a little worse, but in the long run, it's tough to discern in many cases. So again, I think it's a lot better to talk about what these companies are doing when they're spending money. And so I wrote about Vivek Ramaswamy, this anti-ESG activist investor at Chevron, and he makes a lot of points, but one of them is that he wants Chevron to, in the next decade or so, allocate capital how they want to, whether that's long-term fossil fuels or long-term clean energy. But I think we should be talking about that. And a lot of the conversation gets shifted in many cases to talk about, again, what's good, what's bad, but how big companies allocate their money, whether energy companies spend long-term on fossil fuels or cleaner energy. That's very concrete, that's very tangible, it's very important. And whether you want to say that's ESG or that's impact investing or that's another phrase that isn't even invented right now, I think isn't as big a part of that conversation again.
Yeah.
So
go ahead, Diane.
Oh, I was just going to say, so what do you think is going to be the biggest lever in that discussion for those corporate boards and that, and allocating capital? Is it going to be the activist shareholder? Is it going to be the consumers that buy their products? Or
It's an interesting question. And again, I mean, he holds himself like 0.02% of Chevron stock, or at least he did when I broke the story a couple of weeks ago. I think his point is to be part of this like broader conversation about how those decisions are made. And he and others are going up against this tidal wave of capital.
Yeah.
And he argues that BlackRock and others shouldn't take these factors into account. But BlackRock and others and most big companies are kind of, again, beholden to, at the end of the day, pension funds, endowments, and others that control the tens and hundreds of trillions of dollars in some cases. So I think what I keep hearing when I talk to private sector executives is I have big investor pressure. I have pressure coming potentially from regulators. I have, more importantly, to your point, pressure from my end consumers and customers. And I have pressure from now my suppliers in every direction. So if you look at it, it's kind of like rippling up and down. And so, yeah, there might be blips in the road and there might be ups and downs where there's like anti-ESG sentiment, anti-clean energy investing sentiment, but traffic is still moving this direction long term, and no one I talk to is really debating on that point. Because again, if you have automakers saying we need greener steel, steel companies are going to make greener steel. That's their end buyer. That's what they have to care about. And so again, people want to dress this up and make it super complicated. This is about making money and being profitable over time, which is what all these people are.
Do you feel like this? Some of these companies are like, "Woo, thanks, politician, for staying on my side," or do you think they're like, "Oh man, just stay out of it"?
It's hard to say. And again, I think it depends on which points you're talking about. I think big energy companies do want to just invest their money how they see fit. And they've been so unprofitable for so long, like a decade, that investors have now demanded a lot of discipline. And they've said, don't spend on new projects until you know more about what they'll return, and return a lot of cash to us. But I do think, again, the important point now is that that cycle appears to be reaching a tipping point where Chevron, Exxon, and energy companies and other commodity producers like industrial metals, they're now printing money. Commodity prices are actually high. They're not spending a ton, like their profits are through the roof. And they are now sitting on just like this war chest of billions and tens of billions of dollars. And so I think it will be interesting how they decide to spend their money. And I do think they probably think they know how to spend it better than BlackRock and other investors. And they probably do, right? Like if you're a company executive who this is your job, you spent decades doing this, they know these clean energy industries, they know how to be profitable. And at the end of the day, again, that's all they're trying to do is make the most money for themselves and their shareholders. So I don't know about some of the specific like moral and political and other arguments. Frankly, I think they've pushed back on like President Joe Biden making claims about oil companies and price gouging and supplies and stuff like that. So I think in general, they just like to stay in their lane and focus on running their business the best way they can. And that includes, in this day and age, a lot of conversations about climate risk and opportunity and how social issues are filtering into the workplace, and even things like return to office. So I think it's hard to I think they are just so focused on getting through the next 3-6 months and then a year and then managing that way. But I think it's hard to say like, climate risk and opportunity are not fundamental material things to every person and every business. The latest models have us blowing through the 1.5 degrees warming pathway in the next decade. People talk about it like it's some far off thing, but it's happening. And if you can't see it happening, it's kind of hard to have those conversations. But again, I don't encounter that many people anymore and even the anti-ESG movement, they acknowledge, Vivek Ramaswamy acknowledged in his letter, you make the political arguments or whatever, what you will, but he said, like climate risk, he basically says climate risk is a long-term risk and opportunity for Chevron or whoever. But his whole point again is what stakeholders are taking responsibility for that. And he says, like the government should maybe do more, and Congress should basically say, you have to do more, and regulators should say it. And it's not necessarily BlackRock's or Chevron executives' main responsibility. But yeah, his whole point is just like, let's focus on profits and keep the discussions focused on money. So yeah, you can debate the nitty gritty and how this stuff gets done, but again, the traffic is moving in this direction and the train has left the station in a lot of cases.
Right.
Yeah. Can you talk about some of the big investors, top private equity firms that are starting to focus more and more on green energy? I know they're investing in promising startups. And we're seeing, you have obviously the Inflation Reduction Act that are offering tax credits. Can you talk about, private equity's involvement in that space?
Yeah, that's a tough one, again, because private equity firms are so massive and so complex, and they have so many different lines of business, and they invest in infrastructure and all sorts of companies. So yeah, we have seen most, again, big private equity firms say, we can make a ton of money if we handle the energy transition in a smart, sophisticated way, while probably still holding on to our fossil fuel assets in the next 10, 20 years, and on the side making money from those. So let's not sugarcoat it, right? Like, that's Wall Street's playbook, is to make money. And that right now that involves, like, they have these existing fossil fuel assets that when prices are high are going to make a lot of money. They know that the lifetimes of those are winding down. There's like a limited window, but they're going to hold on to those and make money while they can. But their new funds are going to solely be dedicated, in a lot of cases, or mostly be dedicated to cleaner energy or cleaner solutions that are more tied to sustainability. So they are investing a lot, especially in new funds. And we've seen these mega funds. Brookfield just closed theirs with about 15 billion. TPG has one with 7 billion. There are a lot huge private funds out there with billions of dollars available for clean energy startups and companies doing this stuff. And a lot of it is data and technology that they think will be most profitable and underpin a lot of this. But again, yeah, the capital that's being spent now, you would imagine, gets like multiplied over many times. So you can actually get to a place where it's, again, hundreds of billions, if not trillions of buying power. When you layer on those billions, the government is offering billions through the tax credits and other things you mentioned. And so basically any startup in these spaces, any company, you're going to find money. And so again, now it's about permitting, it's about deployment, it's about all the stuff that has to happen to get these solutions to scale and hopefully like accelerate the build out over time. And that's the complicated part that people don't like talking about that much, because it involves a lot of like nitty gritty. It involves steel being put in the ground. It involves construction near your house, God forbid. So there's still definitely a ton of work to do. And these big private equity firms still have a ton of work to do themselves to figure out, what are my total financed emissions? Is the best way for me to divest or to engage with companies? We've seen companies like Carlyle basically say, we want to partner with oil and gas companies in Europe and South America and elsewhere, roll up our sleeves and hopefully lower the emissions over time. It's kind of a self-serving argument because they get to still invest in, again, fossil fuel assets right now. But I do think it is interesting when you talk about what's the best way to actually lower the world's emissions. And it's easy to divest and then you look good, right? Like, you're not invested, that's great, but someone else might pick that up. And the net result might be that there are actually more emissions if a smaller operator no one's ever heard of picks that up and finances it. So I think a lot of those harder conversations, again, are being had, which is good, and more of them need to be had. And talking about this stuff like it's black and white and easy to figure out is a bit silly.
But I think sometimes when I know when I help my clients with these decisions, that sometimes you will look at more activist models, so that, like you said, instead of just like, oh, I'm not touching that, you find a manager that is going to actually try to affect some change. And sometimes that change doesn't have to be huge to be a huge impact, such as I remember hearing a story, I believe it was either Walmart or someone like that, big box chain, switched all its light bulbs in the lighting section, where you go to buy a lamp, to high efficiency LEDs, and it saved, I forget how much in their energy bill, their personal energy bill. So it was good for Walmart or whatever big box it was, but it was also a great environmental thing to not be using that much electricity. So they don't have to necessarily be very diverse. And I don't think also personally that a lot of companies or a lot of people have baked in the long-term costs of certain behaviors. You know what I mean? So we might go, well, that's okay, just keep doing what you're doing. But then 30 years from now, there's a huge class action lawsuit that company now has to pay out gazillions of dollars, mostly to lawyers, Right. So, we're not always baking in all the costs to whatever decision that they're making. Anyway.
Yeah, and it's I think so often it's like total financial cost and total carbon emission / environmental footprint cost. And that is just like a very complicated equation, and you have to kind of optimize for both over the long run, to your point. So yeah, it's again very easy to make a portfolio look super green, but it's, as people are learning this year, it's much harder to make a lot of money that sometimes when energy is outperforming by just divesting. And again, every investor is trying to make money, so
Right.
you have to keep that in mind.
Amazing how quickly people can change their tune from a client perspective. And I actually gave a talk at a church one time on how to be socially conscious in an unconscious world. And this was years ago, but basically it's like, it's almost impossible, because even if you're keeping your money at a bank, so to speak, because I'm just not going to invest in anything. Well, that bank is lending that money. It might be lending to your local developer that's plowing in a river that that's part of the watershed. So it's really hard. It's really hard to be a good person out there.
Right, and I think that's where a lot of reasonable people eventually get to. Right, is I'm an investor. I'm investing money to make more money, and I want to keep these factors in mind, with the idea that the companies that do the best at this, like we were just talking about, they'll probably make the most money. But trying to really change the world with your investments and spending habits is tough when, again, so much is controlled by a handful of big companies.
Yeah.
So yeah, that I think that's what you hear, a lot of different approaches on Wall Street about how people want to engage and do all of that, and how a lot of that happens behind closed doors. So again, a lot of that is self-serving, because then it's hard to measure and no one really makes
Right.
progress. But again, I think it's, again, really hard to argue with tens of billions, hundreds of billions, trillions of dollars that are moving in this direction. But it's also important to acknowledge, like, it's nowhere near enough. It's nowhere nearly fast enough. Like I was saying about, like, the models are pretty clear, like global warming is getting much worse. The climate risks and catastrophes are going to continue happening. So everyone needs to keep moving in this direction and keep doing more, and all
I
of
think
that.
at least now most people acknowledge that climate change is real. My husband's an environmental scientist, so I've been hearing about this for 30 years. And he's just was so frustrated that now all of a sudden he's like, well, at least most people actually believe me, so.
And I think that, to your point about the Inflation Reduction Act, I've been hearing I talked to, again, a lot of investors, a lot of private sector companies, startups, and they're saying that too, right? Like the US got its act together a bit and passed this massive piece of legislation that was bipartisan and got signed, and $370 billion is a lot of money for energy and climate, and all these tax credits and all of this stuff. And the way it was structured for something like hydrogen, where it's a sliding scale, and the lower carbon it is, the greater the tax credit. So that includes carbon capture from hydrogen made from natural gas, which a lot of big energy companies like, and a lot of environmentalists don't like. But a lot of pragmatists generally say that's the only way to make this stuff work, is have a sliding scale that works for big existing companies now, and will let them transition and make it better for startups that are trying to just do clean green hydrogen that might take a long time and a lot of spending. So I think, yeah, the conversations are definitely, they have changed. A lot of progress has been made and all of that. And again, I think it's a lot of the debate is, again, about how we get there and who should do what and what's the role of big investment firms and stuff like that, which again is like good, healthy debate to have. But I think people say anti-ESG and they're like, everyone, a lot of people, they make it sound like a lot of people and a lot of companies don't want to invest at all in climate change, which I think is like not the right way to frame that discussion. It's not really what they're talking about.
Yeah, so kind of finishing up here, Amrith, I want to talk about shareholder activism. There's proxy voting. Are you seeing an increase in proxy voting and activism by shareholders to vote on these initiatives?
It's, yeah, in both directions. So I think there's been a huge increase in like shareholder resolutions about ESG issues, which again, that can mean a lot of different things. It can mean more disclosure about your environmental footprint. It can mean you're just going to measure things like diversity in a new way and disclose more about them. It can mean many, like, certain things about your board of directors and how that's structured and how it performs. So when we say like ESG shareholder resolutions or anti-ESG shareholder resolutions, that's such a broad umbrella, and it can mean a lot of different stuff. And
Right.
many of those resolutions get very muted support. But in general, yeah, we have seen more resolutions, more proposals. There are a lot of people on both sides doing that, which again makes a lot of sense. And I think the broad theme there is like investors are caring a lot about this stuff, and regulators are. We've seen the proposals for greater carbon emissions disclosures and all of that. So yeah, I think that people expect it to continue, and the anti-ESG Chevron campaign by Vivek Ramaswamy is in direct response to engine number one's campaign at Exxon, which was like a watershed moment for climate investors and a lot of people on the clean energy side. So again, the direction of travel, though, it's not clear to me how that changes things that much in the end, right? Like Exxon had to move, and it was an important moment that engine number one came out and said, do XYZ concrete things to move, and they won support from BlackRock and State Street and Vanguard, and that was a big deal. And so Vivek is trying to go to Chevron and say, pump the brakes a bit on this stuff. But at the end of the day, if what ends up happening, right, is like they spend a tiny percent of their like spending budget or their profits more on clean energy or fossil fuels, and again, that's the spending, that's the stuff that actually drives their business and how much money they make. Like if you see what I'm saying, like the shift is not necessarily that big all the time. And we talk about these things like it was a landmark moment that changed everything. When at the end of the day, a lot of these activist investors and everyone else, they're also just trying to raise their profile, make more money. So it's like important to keep sight of like the big picture and how many financial consequences are actually at stake. Like people talk about this like it's a battle for the soul of corporate America and things.
They're looking for that press release.
There's no soul in corporate America.
So yeah,
they're just looking for you to write about them in the journal.
I again try to focus on where's the money going, what's the money doing, how much are you spending, what percentage of your profits is going in these areas, and all that.
All right, do you have anything to say about I don't know if you saw that Senator Toomey was like chastising the SEC about today about their proposal for climate change and how it's probably going to end up in the Supreme Court. I don't know if you have anything you want to talk about on that.
I have not seen that. I've had a pretty busy day.
Yeah, you should reach out. You could maybe get him a quote in your article. But yeah,
I will. Again, I actually have. So I've full disclosure. Like I don't do a ton on the disclosure side. We have other reporters in DC and elsewhere who cover like the disclosures and the impact on companies and all of that. But I think, that has become this very politically fraught topic on both sides, where people are trying to make it seem like a huge deal and politically motivated, yada, yada, yada. At the end of the day, again, long term, like, and you can debate how this gets done, whether it's the SEC or investors, but just generally, again, the end bottom line, investment firms that everyone is beholden to want more disclosures. So you can, there'll be
having some guidelines and having them consistent from company to companies, to me, doesn't seem like a terrible idea.
Right. So I think the specifics of like scope 1, scope 2, scope 3, when most people can't measure scope 3 accurately right now, and scope 3 can be difficult and fraught for most of these giant organizations, and enhance like many different players. Like you can debate the nuances there. You can say it's going to push up costs for some of these companies to deal with regulations, and that's a lot of what they're fighting about, shocker. So you can make all those arguments, and they're important, and it's an important debate to have. But well, again, the people I talk to are just like, a lot of stuff is already voluntarily disclosed, and a lot more will be and needs to be, and it needs to be regulated at the end of the day, is where a lot of people get to and say that, like in the US by the SEC, but also globally. But I think there's more and more data and more disclosure, voluntary or not. So, and again, a lot of that is driven by investor pressure. So at the end of the day, the specifics and the mechanisms and all of that might, I don't know. Yeah, you can fight about it, you can argue about it, but again, I like to always bring things back to where's the money going, what are we spending on, and disclosures help you get there, but they're not necessarily like the hill to die on or the thing to spend hours and hours talking about and writing about in some cases.
I love it. All right, well, let's end there. Amrith, thank you so much for coming back on the show. This was very informative. I know our audience will enjoy it, and we hope to have you again back on in the future.
Thanks so much for having me. Have a good rest of your day.
Thanks, Diane.
Palmer.
All opinions expressed by Rob Santos and Rory Henry on this website podcast interview are solely their opinions and do not reflect the opinions of Arrowroot Family Office LLC or their parent company or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed by anyone as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their opinions. Past performance is not indicative of future results.